And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning. Welcome to the last day of April as we wrap up this month. I'm glad it's over. April was Tariff Liberation Day month. Let's just get it over with, move on down the road. But anyway, so tomorrow starts May. Very quickly, be a little bit careful with May. What you're going to start to see is a lot of articles about sell in May, go away. That doesn't mean sell on the first day of May, by the way. It just means that the summer tends to be a little bit weaker, but that starts in June. May is the last month of the seasonally strong period, so May actually tends to be an okay month. July also tends to be a fairly decent month as well. June, not so much, right? June tends to be a little bit weaker. August, September, October, those tend to be the weakest. So again, we've seen over the last couple of summers, we've certainly seen some corrective periods. 2 summers ago, we had that nice kind of prolonged 10% correction in the markets. Last year, we had that 8.5% slog with the whole yen carry trade blow up. So the last 2 summers have certainly been a little bit more volatile than normal. But May tends to be okay, and particularly after a weak April, May tends to perform a little bit better. Not always the case, as always, we're talking about averages. But again, you're going to start to see a lot of stuff about sell in May, go away. That certainly is maybe not a bad idea, but don't sell the first day of May. Typically, you're going to get a little bit of a rally in the month. And of course, as we've talked about before, we'll kind of touch on that this morning with our Before the Bell segment, but that's going to be kind of a period, take profits, rebalance some risks, those type of things. Again, it's never an all or nothing type situation. The whole premise about sell in May, go away goes back to the 1950s, where if you only, and this is the problem with it, it says, well, if you only invest during October through May, your returns are about 7% a year, and if you invest only from June through October, your returns tend to be about flat. So it's kind of an all-in. Nobody invests just for 6 months out of the year, right? I mean, it just doesn't really kind of work that way. But again, it's statistics, it's analysis, and it's there for you. And you're going to see a lot of headlines on it. Just be careful with it. That's all I'm saying. So a couple of things right now. Trade deficit yesterday, much bigger than expected. That is going to push the first quarter GDP into potentially negative territory. Now, the Atlanta Fed is currently posting about a little bit more than a 1% negative economic growth rate for the first quarter. That's after you adjust for the gold imports. But the Bureau of Economic Analysis is always a little bit different. They have seasonal adjustments, a lot of other stuff that they put in. So their analysis is probably going to show somewhere between 0 and probably about 0.5% growth for the first quarter. Now, we're going to get that number in a couple of days. So I believe tomorrow we'll actually get the first estimate of the first quarter GDP. Now, be a little bit careful with that, because that number, that first estimate, is just a estimate based on the current Wall Street economist estimate. So they just basically take all the economist estimates, they lump those up, and they say, okay, well, these guys are all pretty smart, so that's our first quarter estimate. Now, in the next 2 estimates that we'll get in May and June, we'll start to actually have the data in it. So again, this first estimate, take a little bit of grain of salt, but it's probably going to show a pretty weak number, near 0 most likely, because of this record surge in the trade deficit. Now, this was just basically front running of all these imports. And again, if you take a look at how we calculate GDP, it's about 70% personal consumption expenditures, about 15% is business investment, and then you've got government spending and net exports. So that net exports is what's weighing on the growth potential for the first quarter. X that out, which we won't have in the second quarter, we won't have all that front running in the trade deficit, that number is going to come up a bit. So we'll see, this isn't going to be recessionary. You're going to see a lot of recessionary headlines coming out. It's like, oh my gosh, a negative print, just assume it's negative. It's a negative print GDP first quarter, so recession's here. No, probably not, because again, that second quarter we're not going to have all this front running of tariffs, and that's all been done. And the other problem with this is that now that I've stocked up on all this inventory and I ran out and I bought all this stuff ahead of tariffs and I overpaid for it because all the prices went up because of all the demand for getting supply in ahead of tariffs, now I've got to liquidate that inventory. And if consumers aren't there to basically buy all this excess inventory, I'm going to have to mark it down, sell it at a loss. That's going to impact earnings. So this is also going to have a little bit of a negative feedback loop. It's that kind of that boomerang effect of what happens in the markets by when you pull forward activity like that. But again, that's something that is going to certainly be an issue to look at. But this trade deficit that we saw in the first quarter, it's not going to exist in the second quarter most likely. So again, we'll see a bit of an improvement. But again, you're going to see a lot of, tomorrow when we get a GDP report, a lot of headlines about, oh my gosh, recession. Be careful with that. Probably not yet. And then on Friday, we get the employment number, which will also give us a good indication about how things are going in the economy. That's expected to still be pretty strong. All right, let's talk about what you need to know before the bell. Yesterday, markets rallied a good bit in the afternoon. We kind of started off weak in the morning, turned around early morning, and then we saw some buying coming in. This has really kind of been the stint of the market over the last really kind of a week or so, is that we consistently see buyers coming into the markets, particularly late in the afternoon. Importantly, what as we kind of been talking about the last kind of 2 days, is that we broke above this kind of that previous resistance line that we had of that double bottom just prior to the tariff announcement. So we broke above that yesterday. That's bullish. This morning, markets are going to open a little bit weak. Not surprising. We've had 6 straight days in a row of advances. That's a pretty long stretch for the markets to run just consecutively higher every single day. 6 days is a pretty long run. So we're probably going to see a little bit of weakness maybe today. But again, looking for a bit of buying later this afternoon. Maybe markets close kind of close to flat. That would be helpful. But again, we're about to run right into the 50-day moving average. And then, of course, we've got the 200-day moving average right above that. So the markets have had a so we've had this, this near 20% decline. Peak to trough is about 19.2%. We've had about a 50% retracement of that so far. So again, the markets have done a good bit of recovery work here. We're running into that initial resistance. And as we talked about, if you were really stressing out of your portfolio down here, and really concerned about the markets and just wanted to get out of the markets, and we were kind of warning you, like, be careful with that, because that's that emotional starting to weigh in on you. This rally has been a very good rally now to start rebalancing some risk. So again, as we talked about, use this now. Use this rally here. We talked about neighborhoods and addresses before. Don't look for a specific number, a specific address for the markets. We're in the neighborhood of targets. And again, it's like, well, if as soon as I get back to the 50-day moving average, I'll sell something. No, sell today. Right? We're close enough. Sell some today. Doesn't mean sell everything. Doesn't mean go to 100% cash. But take some profits, raise a little bit of cash if you haven't done so already. We've been doing that work, during there's the last kind of phase of the rally over the last few days. But again, take a little bit of action here. Rebalance that risk, lower your volatility exposure. This correctional process is most likely not done yet. Would not be surprised at all to see this market come back down and then start to kind of work in a zigzag pattern to move itself higher. So then you can use, if you raise a little bit of cash here and have some opportunistic funds to work with on these subsequent declines for whatever reason that they come along, whether it's weak economics, more concern from over tariffs, whatever it is, you'll have some money to basically add back into the markets at lower prices and continue to rebuild your portfolio back to where you want to be. The other side is paying attention to interest rates. Interest rates heading back down to 4%. Looks like most of that kind of bond scare that we had in the markets has now kind of been resolved. This was that basis trade that we had talked about, and that looks like it has come back, has passed, and markets are now stabilizing. And with oil prices falling, we've now got yields coming down. Just triggered a sell signal, which suggests lower yields here to come in the near future. So again, kind of looking like markets are now kind of getting back to normal. That's what you need to know before the bell this morning. We'll come back, get back with the show right here on The Real.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So it is, of course, Wednesday. It is the last day of the month, which means it's also the big day, one of the big days for earnings. Microsoft today, Meta today as well. And then tomorrow we're going to have Apple and Amazon. So 2 big days of earnings here over the next 2 days. They'll certainly be moving the markets. A lot of expectation about and it won't be really about what they report in terms of the numbers. It's going to be really their focus on AI. Are they increasing CapEx spending into AI? Are they expanding their AI footprint? Kind of what's their discussion on that? I mean, revenues are going to be important, particularly when it comes to Amazon. They'll look at the AWS, their kind of their server revenue, see how that's going. And again, with Amazon, their focus on AI. What's Apple doing with AI in terms of bringing that into their phones? What's kind of what's next for Apple? A lot of focus with Apple too. When they report tomorrow, will be on the impact of tariffs on their numbers. So people will really be looking forward into what to expect over the next quarter. So, Apple has a fairly substantial risk, to earnings here, at least on their outlook. Now, one thing we're not getting right now is a lot of forward guidance from companies because there's just too much unknown. There's, right now tariffs are back in flux again, unfortunately. They're at 10% for 90 days, but then what happens after 90 days? Do we have tariffs? Do we not have tariffs? Do we have tariffs with some countries and not with other countries? Those type of things. So, a lot of companies are pulling their guidance because they just simply can't guide. I mean, it's like, I wish I could tell you what the future looks like. I just don't know. And so that's going to cause a little bit of consternation. But expectations are right now for Microsoft and for Meta today, earnings should be good. Again, the focus is going to be their view on, and like with Meta, what are they doing with Llama, which is their GPT software. So what are they doing with their AI? How are they developing that? What's going on with their Meta business? The ad revenue for Meta is going to be very important as well. Is that increasing or decreasing? And that really come back down to companies, because are companies spending more on social media marketing or less? Are they starting to pull back because of economic concerns? So there'll be a lot of stuff to analyze and that markets will go through. But again, expectations are is they should come in line with their estimates, if not beat them. We have lowered estimates across the board. But that will be moving the markets tomorrow and then on Friday because of Apple and Amazon. So we've got a couple of days here where markets could be a little bit at risk from the Mag 7 or not. Unfortunately, we just don't know. So we'll find out. But again, those are two big numbers coming out over the next 2 days. Also, tomorrow, as I said, we'll have the GDP report. Today, we have several reports coming out as well. And so really today and tomorrow, we're going to have a good bit of economic data. We've got, sorry, I said that backwards, actually. Today is the GDP annualized number. Tomorrow is jobless claims and global manufacturing. So the jobless claims numbers really haven't been moving a whole lot and don't expect them to move a whole lot. Then on Friday, we've got the actual employment report. But today, we'll get that GDP report. We'll also get personal consumption expenditures because that comes out with GDP. PCE makes up 70% of the GDP numbers. So we'll get a good look at kind of what spending looked like. Visa reported earnings yesterday. Fairly strong report from Visa, which certainly doesn't suggest that the consumer is slowing down very much. Consumers are out there still charging up credit cards at this point, not because they have a choice, but because they have to make ends meet. But again, their report was pretty strong. So I would expect to see that PCE is probably not showing any real signs of weakness. May be surprised, but PCE has been pretty strong over the last couple of years. A lot of it had to do with the stimulus checks, the excess savings, those type of things. Now, a lot of that's running out. All that kind of excess savings that consumers had is running out. They are having to resort more to credit, buy now, pay later. There was an article yesterday talking about how more and more people are now using buy now, pay later to buy groceries. Now, if you're not familiar with the buy now, pay later, it's a program that was set up by private companies that says, okay, you can borrow some money today and make 4 equal payments on it at no interest. But if you don't happen to make the 4 equal payments, your interest rate's 36%. So, it gets people into trouble pretty quickly. But you're seeing it started out for just like big ticket items. It was like, oh, you want to go buy a new Xbox or a new flat screen television or whatever. You can do it on 4 equal installments. We've seen PayPal pick this up. Affirm, Klarna, they've cut deals with major retailers like Walmart, etc. Costco, so if you want to go buy a flat screen television that's $500 or whatever it is, you can make 4 equal installments at no interest, and it's all cool, right? Just make sure you make the payments. Otherwise, it's 36% interest. Problem now is that people aren't using it just for big ticket items. They're using it for McDonald's, buying lunch, going to the grocery store and buying groceries. And that certainly suggests that, two things. One, the consumers are strapped, right? That savings is gone. So we're certainly going to see probably weaker consumption numbers as we go forward. Again, and this is going to lead to slower economic growth, lower rates of inflation, because that's all driven by demand. The demand component of the economy is slowing down, and it's slowing down pretty rapidly. We've talked about rising delinquency rates, those type of things. But the other problem with this is that there's a whole nother risk pool that's sitting out there that we haven't really analyzed before. And if all of a sudden there's a massive wave of defaults, now buy now, pay later is not big enough to be the next subprime crisis, right? It's just another risk pool that's out there. So again, if you start seeing, and a lot of that buy now, pay later stuff, it isn't actually incorporated into a lot of the data that we've used. So when we start talking about credit card delinquency rates and those type of things, we don't have the data for buy now, pay later. It's because it's not been incorporated. Now in the next couple of years, I am sure that FICO and some of the other credit agencies are going to start incorporating buy now, pay later into credit ratings. But right now it's not. So there's a risk pool that's sitting out there that we don't have a really good handle on. We really don't know how big it is for certain. It's big, it's a few $1 billion. But we don't know how big it is, and we don't really know what that impact is if there's, a lot of defaults that start to pick up. Obviously, companies like Klarna and Affirm, who are publicly traded companies, Affirm is, Klarna is not. Klarna is about to be publicly traded. But there's certainly risk to those stock prices, those company prices, if all of a sudden there's a big wave of defaults. Because again, if the problem, if you think about it with buy now, pay later, is this. If I loan you money for a house, right, and you don't pay for the house, I'll come get your house, right? Or if I give you money to buy a car with, I'll come get your car, and at least I can resell your car and get some of the money I loaned you back. I'm not going to get the full amount, right? Because cars depreciate as soon as you drive them off the lot. But if I loaned you $20,000 for a car, I can go get the car and sell it and get, $12,000 for it in a fire sale and at least get some of my money back. The problem with buy now, pay later is what I'm going to do. I'm going to come get your McDonald's lunch back from you. I really don't want it. Not much I can do with that. So there's not a lot of recovery. And again, people that are using buy now, pay later to an extensive degree, they probably don't have a lot of assets. So there's not going to be a lot of recovery in this buy now, pay later type environment for companies like Klarna and Affirm. If there's a big rising rate of delinquencies. And again, there's not yet, right? I'm not saying there is. But again, that's a risk pool that's sitting out there that we don't really have a really thorough understanding of what's happening there because there's not a lot of public data on it to analyze. But again, so we'll look at PCE today, employment cost index, what's happening with companies' payrolls, GDP, of course. And then also we get the Chicago PMI out today. So again, that data has all been fairly weak. And we had consumer sentiment out yesterday. Consumer sentiment fell off pretty sharply, very low level on consumer sentiment. Interesting enough, in that consumer sentiment survey, the number of people expecting higher incomes in the next year has fallen very sharply. People expecting to be able to get a new job has fallen very sharply. The most interesting aspect, though, was at the beginning of this year, I published a chart for you and showed you that the expectations by consumers about higher stock prices in the year was at a record high. As of the end of April, that is now back near a record low. So just because of this recent 20% correction in the markets, the expectation for higher stock prices has completely reversed. Now, what's interesting is that's actually backwards. Because after the correction, your expectation of higher stock prices in a year should be going up, not down. But it just goes to show you how investors think about markets. So anyway, all right, come back, pick up with the show. Don't go away.
Life is an illusion. Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I've never seen so many economists and financial people become epidemiologists in my entire life, right?
It's a Christmas miracle.
I know, right?
If your choice is death or listen to Lance Roberts, I'm sure I might win at least 20% of those.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Talk about tariffs and inflation here for just a moment, because lots of kind of recent headlines, articles coming out is like, tariffs are going to cause a massive spike in inflation because, if you put a tariff on to a product and people have to pay more for it, that's obviously inflationary. And we also have to go back, and that's a true statement, right? I mean, if you, I saw the other day, we've talked about Shein and Temu on the show before. My kids love Shein because they can go on Shein and they can buy, all kinds of like dresses and shirts and everything else, and the total bill's like $6. Like when we went on summer vacation this past summer, I took the kids to Greece for the summer for vacation, and they went on to Shein and they bought their whole wardrobe for going to Greece. Their bathing suits and their sundresses and all that type of stuff. And the total bill was like $63. I mean, it was ridiculously cheap. But I saw this clip the other day that it showed the prices of Shein before and after tariffs. And for instance, there was this particular hairbrush that before tariffs was 53 cents and after tariffs was $1.53. Just a variety of things like that. And most of the stuff on the list was less than $4. And so after tariffs, it was like $6 or whatever it was. But there was certainly an increase for that, right? So that's inflationary. Get that. But the one thing that economists are missing, and a lot of these, kind of Wall Street reporters or kind of your
kind of your generic media reporters that, are just reacting out of, tariff fear more than anything else, is they don't really understand the how we build the composite for calculating inflation, which is the CPI index. 44% of that number, when we talk about inflation, is what's called homeowners equivalent rent, so effectively housing. Is there a tariff on housing? So think about that for a moment. If we have tariffs, but 44% of the inflation calculation is based on housing, is there a tariff on housing? Are we having to pay more for a house because of the tariff or not? Right? Automobiles certainly feed into that, right? Because there are tariffs on automobiles, except now we've paused tariffs on automobiles, but yes. But transportation is also comprised of energy, oil, gasoline. There's no tariff on that. Food, that certainly is a more significant weighting within the component of the index, but still much smaller than housing by a far degree. But there's not tariffs don't equally affect food across the board, right? Only the stuff that we import. So my point about that is that yes, tariffs are important, and tariffs are going to cause higher cost to individuals. It certainly has the ability to impact inflation. But when we look at the inflation composite and how we calculate inflation itself, it's not going to create 10% inflation. We're not going back to the 9% inflation rate that we saw a couple of years ago when we had sent checks to households and shut down the economy. Sure, inflation could uptick, from 2.4 back to maybe 3%. That's still very low historically, right? So we could see an increase in inflation because of that. But most likely because of the downward pressure that we have in oil prices right now, the downward pressure that we have in housing prices right now because of what's happening in the economy, supply and demand, those are big weightings within the index, which means that if there is any impact to inflation at all, it will be very minor. So just want to put that into a bit of perspective because, again, you see a lot of headline fear about this. You see a lot of people talking about it. I posted a tweet this morning talking about the return of inflation back with oil prices. And oil prices drive two things. They drive oil prices and interest rates because of their impact on the economy. And so this was a chart I posted this morning. So this is crude oil versus the annual rate of change in interest rates. And that correlation has now returned back to normal. And so we've seen over the last few days in particular, we've seen interest rates coming a bit down. I talked about this morning on the Before the Bell segment that basis trade issue that we saw seems to have resolved itself. Interest rates are returning back down to where they're supposed to be. But as oil prices continue to decline here because of a lack of stimulus, lack of economic growth, and right now, the Trump administration is focused on drill, baby, drill, which is not inflationary because the more supply for oil that you have, the lower the price is going to be. And they want to get prices down because that's going to lower the cost of inflation because of its input into the CPI calculation. But interest rates are tracking along with that. Secondarily, this is the same chart of oil prices versus inflation, and you see the same set of correlation. And again, oil has a very short-term impact on inflation because of its usage within the global economy. Oil impacts everything within the economy. Yes, housing makes up 44% of the index, so goes the housing market, so goes the inflation index. But oil has a big input into that. Transportation, food, energy, all that, all gets fed into there. And that's why there's a correlation between CPI and oil prices. And right now, there's really no downside floor in oil prices. Oil prices get a little bit oversold here, so they could get a little bit of a bounce. But the more drilling that they want to do and the more they want to open up drilling in the U.S., the more downward pressure that we're going to see on oil prices. Now, the flip side of that, which is not great for oil investments, oil companies, is that they're going to have a decision to make of drill, baby, drill. Drill, baby, drill sounds fine until it's no longer profitable for the energy company. Then they go, well, we're just not going to drill because there's no money to be made in it. And at the end of the day, oil companies want to make money. So there is a downside floor to where supply basically gets shut off and prices will stabilize. But right now, that could be in the mid-50s. So there is some downside risk to oil prices. If oil prices decline more, that's going to feed into the inflationary pressure. But here's a real important point about this, and this was a comment that I received, off of this, was the inflation numbers are not real. It's your job to show this. Compare it to 1980, and the CPI numbers are all fake. You cannot run an economy with fake numbers. Okay, so first of all, he's wrong. Entirely. But this is that fear-mongering that goes on. So 2 things about CPI calculation. 1, we calculate inflation differently today than we did back in the 1980s. In the 1980s, we calculated it based on a basket of goods, and we have changed that calculation because the world has changed. Right? Computers, phones, all these other things that feed into it, we had to change, and rightfully so, change the way we calculate inflation. Now, do we calculate inflation in a manner to suppress the real rate of inflation to keep Social Security payments down? Absolutely. That was the Boskin Commission back under the Clinton administration did that. So does inflation accurately reflect the cost of living for the average American? No, it does not. Now, here's the punchline. Who cares? Do you want to make money in the markets or not? That's the question. I mean, because what we're talking about here is we're talking about investing. We're not talking about your personal living standard. We're talking about investing and making money. I don't care what the inflation rate was back in the 1980s. What I care about is what the inflation rate is now, because that's what's going to impact the markets, and markets are going to trade off what the inflation number looks like right now. I don't care what your personal living, kind of condition is. Whether you think the price of eggs is too high or too low, or the prices of cheese have gone up or down. I don't care, right? You may care, and that's completely fine with you. But all I care about personally, I care about you because you're another human being, and I certainly care about your situation. I'm talking about investing. From an investing standpoint, I don't care what your view of inflation is. I only care about what the market's view of inflation is, and all the market's going to trade off of is what that inflation print is. Good, bad, or indifferent, because that inflation print is what the Fed's going to drive off of. So you may not agree with it, and that's okay. There's nothing wrong with the fact you don't agree with it. I don't think, my personal living inflation number is a lot higher than what CPI says, right? But when it comes to investing, I can't let that interfere with my view. I want to make money. So I have to respond and react to what the numbers are, whether it's the employment number, whether it's the CPI number, whether it's the economic data. It took me a long time to learn this. I used to be this staunch, contradictor of economic data numbers. And it took me a long time to realize that my view doesn't matter. It only matters what the market thinks. And so when you come to that realization and realize, look, I'm here to make some money. I'm investing capital. I want that capital to grow. I can have all of these opinions that run contra-narrative to what the market data is saying. But at the end of the day, the market data is what I've got to work with, because that's what the markets are going to respond to. So you got to kind of pick your poison, so to speak, right? Do you want to make money and fight the fight about what inflation really is? Or what? Make a choice. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just getting ready to wrap up the show a little bit. So again, just kind of talking about narratives. Again, as you're focusing on managing your money, managing your portfolio, whatever it is, it's really easy to get wrapped up in headlines and our own personal views and those type of things. And again, just the point is, at the end of the day, we've got to step back and look at what the data is saying, because again, all the markets are going to care about is what the data is, and they don't care about anything else. And there was a comment in chat earlier about trying to support my bullish view. I'm not bullish or bearish on markets. I never am. If you read our website, realinvestmentadvice.com, or you go to our Substack page, you're going to see articles all over the place. Some are bullish, some are bearish. I'll make cases for why there's economic slowdowns coming and earnings declines, and consumers are tapped out. There was a recent article. And then at the same time, you'll see articles talking about short-term bullish narratives, because again, markets are going to do what they're going to do. And you do not make money being bullish or bearish. If you're bullish, you're going to be wrong and lose money. If you're bearish, you're going to be wrong and you're going to lose money. So it doesn't really pay to be bullish or bearish. It just pays to pay attention to what the data is saying and navigate the markets for what they are. And because again, at the end of the day, that's all that we're here for, right? The only reason you're listening to the show is because you've got money invested in the market. If you have no money invested in this market, you're not listening to the show this morning because you don't care. If you've got money invested in whatever it is, that's why you're listening to the show this morning. So let's just trade markets for what they are and deal with what the issues are and analyze the data for it. And we're going to get some of it right. We're going to get some of it wrong, and that's okay. And we'll change. We'll say, hey, look, we were wrong on that, and we're got to change it and got to do this. But that's investing, and that's management, and that's what we talk about, risk management all the time, and not making these broader macroeconomic views that you don't have any control over. And again, what your personal view of inflation or the markets or tariffs are doesn't matter. What's the market saying? So again, let's focus on the data. and start setting aside all of our personal views, because 9 times out of 10, your personal views are wrong. They're driven by some bias, some, confirmation bias structure that you're working on, whatever it is, some thesis you've got developed in your head that is probably mistaken in a lot of cases. It was interesting. There was a comment, when I was showing you that chart a minute ago about interest rates and oil prices, and but what about Bitcoin? It's funny, my wife is actually going to a crypto conference very shortly. She's about to go to Vegas for a crypto conference. As I told you before, my wife sells LNG, which is liquefied natural gas, that her customers are companies like SpaceX and others that use liquefied natural gas for energy when they need it for, SpaceX uses LNG to launch rockets, or Tesla was one of her customers because they needed it for a power backup source in case the electricity goes out. So companies use LNG for a whole variety of things, whether it's asphalt or marijuana growers was some of her customers that she has out in other states like Oklahoma, because they've got to keep the buildings where they grow the marijuana at a constant temperature year round. And they use LNG for that, particularly in areas where they're kind of more off grid, where you're growing marijuana in a lot of cases. So you need a steady source of power. So LNG works well for that. Anyway, but crypto miners use it also to power mining because it's cheaper than electricity. And as you know, crypto mining requires an immense amount of electricity and power to mine a Bitcoin. In fact, there was an article out that is costing right now about $137,000 in the US and about $200,000 in Europe to mine a Bitcoin. So there's a lot of money that goes into that mining operation just to mine that currency or that Bitcoin, whatever. Anyway, so she's all excited. So she's going to go to this. She knows absolutely nothing about Bitcoin. Absolutely nothing. Right. But she's all excited about going to this conference because she's going to sell LNG and she'll do it too. She is a salesman, extraordinaire. She can sell literally icebergs to Eskimos, no doubt about it. In fact, I think that's one of her customers. So, but she's one of these people, and this is what I was trying to explain to my kids the other day, and I think we were talking about this maybe on the show yesterday with John, talking about teaching kids to pick up phones and talk to people and those type of things. She is not afraid to talk to anybody. I mean, people say it's like, hey, we want this customer. Do you think you can get him? She's like, yeah, she'll just start dialing the phone until she'll dial the CEO of the company and work her way around until she gets somebody to answer the phone, and then she'll start selling product. And that's just the way she is. But she's just not afraid to talk to anybody. And, that's what makes her a really, really good salesperson and really good at her job. Anyway, I digress. I forgot where I was. Crypto. Well, no, we were talking about crypto. There's just the side. No. Before that, way before that, I was on a track talking about personal views, right? Whatever your Brent, you're no help. Okay, your dementia is like immediate. So that's why you have notes. I know. So if you only saw what went on behind the scenes of the show, sometimes there's whole outtakes that we could have. But anyway, the whole thing is about personal views. Just be careful of your personal views. And again, we're going to get some data out today, GDP reports, PCE reports, those type of things. And, you can spin it however you want, but the markets are going to respond to it for what it is. So again, are we investing? Are we here to make money? Are we here to debate the narrative? Because, one makes his money, one doesn't. So, you tell me what y'all want to do. And, you're the one that's listening to the show, and we value your time, and we appreciate it. So make sure and like and subscribe to the channel if you're here. But if you don't want to talk about how the markets are responding today and you want to talk about narrative, we can do that. It's not very beneficial, but we can certainly do that. Right? So again, it's really important to just set aside stuff that you read and most of the stuff that you read, like on Zero Hedge and other places, and again, it's fine. Just quantify it for what it is. If you read an article from Peter Schiff, just understand he has a message that he is trying to send out to sell gold. That's his thing, right? So everything he writes is end of the world, doom and gloom, and gold is all that's going to matter. And that's fine. There's nothing wrong with that. Just understand that his narrative is mostly wrong the majority of the time. And the outcomes that he's predicting aren't going to happen in reality. So we need to trade that accordingly. And again, nothing wrong with it. I'm not saying there's anything wrong with those views or anything else. It's just we have to understand what they are and what the motivations are, and again, how markets are going to react. And and as we talked about yesterday, in particular, when you talk about possibilities and probabilities and standard deviations of outcomes, the end of the world scenarios never come, right? And we have pretty bad outcomes for sure, but Armageddon, those type of things, they don't happen. The probability of those are so infinitesimally small that making bets on that type of an outcome is a losing strategy over time for making money. And again, back to the beginning of our conversation, we're here to make money. That's what we're here to do. So anyway, one of the things to be paying attention to, again, this afternoon will be earnings. That's going to move the markets this morning. Right now, yields are down to about 4.1%, big reversal from 4.5 just a couple of weeks ago. Again, things are just trying to realign themselves with economic realities. S&P is going to trade down about 19 points at the open here this morning. This is before the data comes out. So again, markets are down a little bit right now on the futures, but by the time this data comes out, depending on what the data looks like, we could have a big swing in futures in either direction. But right now, markets look like they're going to open a little bit soft this morning. Not surprising, 6 days of advance that you're going to give back a little bit of it. That's should be expected. But again, as we talked about earlier, this is where take some profits, rebalance some risk. If you've had a decent run here, a decent recovery, this is a good point to start rebalancing some of that portfolio. So again, if you owned a bunch of high risk stocks that really took a beating, in the month of April, reduce them now. It doesn't mean sell everything. You may love the company. It may be the greatest company on the planet in your opinion, but if they were down more than 20% during the decline and they've rallied back somewhat, that just means they have excess beta volatility, which is that's impugning your portfolio, which means your portfolio is going to fall faster than the markets when that occurs. And again, rising faster than the markets when markets are going up, that's the easy part. It's surviving the downturns that are very difficult for people. So reduce that position a bit. Doesn't mean sell everything, but just reduce it. Get it weighted within the portfolio. We've talked about turtle trading before. We've talked about strategies. We've talked about weighting portfolios, weighting allocations. This is the time to start looking at, go through your portfolio, look at each line item in your portfolio and say, okay, what's my weighting in that relative to my whole portfolio? My target weighting is supposed to be 2%. It's now 4%, whatever it is, and just rebalance that back to what target weight should be. And be reasonable, right? And set a limit. No position of my portfolio will ever be more than 5% of my portfolio, because the reason for that is that if that position goes to zero, you can lose 5% of your portfolio. That's better than losing 20% of your portfolio. So be careful with concentration, be careful with risk management, and you'll do better over time. All right, wraps up the show for today. Be back tomorrow with Michael Leibowitz. We'll catch up on earnings, data, GDP, all that tomorrow, and what that means for the bond market and more. See you then. Have a great day.
We're conservatives